Hey everyone, we'll get started in just a second. Okay, we are recording. Let me share my screen and we will kick things off just a second here. All right, screen should be up and running now. So without further ado, let's go ahead and get started. I want to first of all welcome everyone to today's presentation on market volatility. Thank you all for being here with us today. In interest rates, inflation fears, political events, international developments. Since the beginning of this year, every single one of these events has influenced stock prices. So when you hear that the financial markets are reacting to the news once again, it should come as no surprise. We know volatile markets can be unnerving, and that's why we've gathered you here today. We've also, I should add, asked the somewhat provocative question whether investors should, quote, sell in May and go away, end quote, which is, by the way, an old Wall Street traders adage about taking profits before the historically less active summer months set in. Spoiler alert, the answer is no. Investors generally should not sell in May and go away because the longer you're in the market, the more likely you are to expose your portfolio to the potential for growth and compounding. But what you should do is inform yourself about the best practices for investing and learn how to cope with the inevitable ups and downs that the market goes through. So, with that, let's get started. First, let's get the introductions out of the way. I'm Josh Brockwell, Investment Communications Director here at Azad Asset Management. I'm responsible for all things marketing and communications, and I also head up our shareholder advocacy program. With me today is Raj Mahmood. Raj started a career in finance in 2005 and has gained extensive knowledge in financial planning throughout his work at various firms in the DC area. Raj holds the Certified Financial Planner certification. He also holds the Chartered Retirement Planning Counselor, or CRPC, professional designation. His passion is helping people get on the right track to achieve their goals. Let me skip ahead here. For those of you who may need a refresher, here's a quick look at who we are at Azad Asset Management. We manage around $1.8 billion as of December 31, 2025. And we also manage money for clients across the United States. We offer socially responsible halal investment solutions, founded back in 1997. And what makes Azad unlike many other financial firms is the quality and nature of our advice. It's centered around you and your family, driven by a higher purpose, and designed to help give you peace of mind, knowing your financial life is on track. As a reminder, we are a full-service financial planning advisory firm. Here's a brief overview of the services we provide on your screen now, from investment planning to tax and charitable planning to halal financial services. We've positioned ourselves as the leading provider of halal financial services in the United States. With that, let's jump into our content for today. Okay, we are all here because volatility has reared its ugly head in recent months, sparking a little bit of panic in some corners. But volatility simply means prices that move up and down. It's not abnormal. It's a core feature of markets. And also, by the way, just a reminder, volatility can be a good thing. Volatility can create buying opportunities and drive long-term returns, rewarding disciplined investors. This graph on the screen right now provides a visual representation of how market volatility, as measured by the VIX, has changed over time. It highlights that volatility is not constant, as you see on the screen there, and it can spike dramatically in response to market events. In essence, the VIX is a measure of how much the market expects to change in the near term. So this often reflects investor fear. It's sometimes even referred to as Wall Street's fear gauge. Basically, though, the VIX measures market expectation of near-term volatility. Despite this, by the way, major indices like the S&P 500 and Nasdaq have bounced around all-time highs in recent weeks. Also, word now about the Middle East conflict. You've likely been following the headlines about the military conflict in the Middle East, and we wanted to address that head on and to share our perspective on what that could mean for your portfolio. So, in a nutshell, here's what's happening currently. The escalation of military operations in the Middle East obviously has introduced new uncertainty into global markets, with oil prices climbing in response to the American blockade of the Strait of Hormuz. Aside from the obviously tragic loss of innocent life due to the initial conflict and subsequent economic sanctions and ramifications, the primary concern for market participants centers on the Strait, which is a narrow waterway off of Iran's coast through which roughly 20% of the world's daily oil supply flows, or it did prior to the blockade. The sustained disruption there has pushed energy costs higher, which has clearly unsettled the markets and may now start to trickle down to consumer prices. We've seen some of the inflation numbers just came out for April, the highest in years. And it will likely take months for crude to flow freely through the Strait once again. Here's what it means for you, though. Market volatility during geopolitical events or oil shocks like this one is expected. We've seen situations like this before, and markets adjust to the news over time. We've seen it happen. They kind of shrug it off. Your financial strategy was built to weather periods of uncertainty like this one, regardless. Your portfolio, ideally, reflects your goals and time horizon. So, reacting to short term headlines can be a mistake. History has shown time and again that during periods of volatility, it's important to stay disciplined. Now, obviously, at Azad, we're still monitoring things as the situation remains tense, and we are here for you. If you have questions or simply want to talk things through, please do not hesitate to reach out. That's exactly why we're here. But for some general context and how to think about these recent events and the volatility that they've kicked off, let's go through a few key points for investors of all stripes to consider, no matter where you are in your financial journey. I've talked enough. So for that, let's turn things over to Raj. Raj, thank you for being here today.
Yeah, absolutely. Thank you, Josh. So, with everything that's going on, some people might be unsure about investing in financial markets at all, right? Because we know it's definitely riskier than keeping your money in cash under your mattress at home and not necessarily worry about it. So, why invest? Because it does involve risk. Well, the biggest reason, as you can see on your screen, is inflation or rising prices. And this reduces your spending power. So as you can see on your screen, from 2024, December 2024 to December 2025, the CPI as a whole increased by 2.7%. And if you narrow it down even more, food prices increased by 3.1%. And then if you break it down further, eating at home versus eating out, 2.4% increase at home and another 4.1 increase eating away from home. So the point here is to illustrate that we need to find a way to keep up with inflation, at least keep pace with inflation. And that's why investing is so important. There's potential for losses with investing. We understand that. But there's also a possibility of some significant and nice gains over a long period of time. The large part of investing is about figuring out how to properly balance that risk and reward relationship and which risk management strategy makes the most sense for you as a client and for you as an investor. And that's where I can help. That's where Azad advisors can help. We help clients tackle this thorny issue address this head on, and put together a strategy that is the best suited for your risk tolerance. We also know watching financial markets go up and down can be very, very nerve-wracking. But keep in mind, just as Josh mentioned, periods of market turmoil are normal, they're expected. It is important to take the long view with investing, not look at it over a short period of time or short-term market volatility. It distracts you from your long-term financial goals. Staying invested over the long haul puts you in a good position to reach your financial goals. Next slide. The best advice we typically give our clients is to stay invested even when the times are turbulent, the market is volatile. Investors forget that the cost they must pay for potentially higher long-term returns is short-term volatility, kind of like what we've seen here lately with the Iran war. Some investors think they can get in and out of the market without any consequences. And let me just address this. This is very dangerous. When you get out, you will likely need a lot more time, and your investments will need a lot of hard work to get back to where you were if you had just stayed invested. So the point is, don't try to time the market. No one knows the perfect time to get in and out. Equities typically accumulate most of their gains over just a handful of trading days. So as you can see on your screen, if you miss those days, you will be significantly behind. We know that missing a handful of the best days drastically reduces the return you could have gained by simply holding on to your investment. Avoiding the market's downs, they may mean you missed the ups as well. 78% of the stock market's best days have occurred during a bear market or during the first 2 months of a bull market. So if you missed the 10 best days over the past 30 years, your returns would have been cut in half. And missing the best 30 days would have actually reduced your returns by an astonishing 84%. So again, the lesson is it's not time, it's not timing the market, it's time in the market that helps you grow your wealth. And I work with prospects all the time. They come to us after they've panicked, they've gotten out of the market, and I can't tell you how difficult it is to help them understand why they need to get back in. They need to get back in ASAP so they can make up for that lost time. And more often than not, the reason why they got out in the first place is because they couldn't follow their investment strategy. They couldn't follow their investment plan. They weren't working with a trusted advisor. So work with an advisor, be honest about your risk tolerance. We're not saying be aggressive, we're not saying be conservative, but go with what is best aligned with your tolerance for risk and find something that you will stick to even when the sky is falling. So, next slide. Staying invested applies during bad markets and declines. It's true they can hurt. Seeing your account go down, there's nothing great about that. I know it can be painful, but remember, the declines are normal, and we have history to back this up. If you look at the slide on your screen, going back all the way to the Great Depression to 2022, which was the last time we saw a bear market in the S&P 500. And just to kind of clarify, a bear market is defined as a decline of 20% or more from recent market highs. And we kind of flirted with that during the volatility along Liberation Day in 2025 when President Trump announced all those tariffs. So while declines have varied in intensity and frequency, they've been regular events. History has shown financial markets have rebounded from market shocks, posting strong long-term gains. And short-term market fluctuations, we know they can stir up a lot of emotions, may even lead to making unwise investment decisions. But whenever possible, just take a step back, right? You're not investing for a week or a month or 2 months. You are typically investing for 10, 15, 20, 30, maybe even longer. And we need to create a viable investment strategy that generally outlasts this volatility. And volatility, we know it's short term, but long term growth is definitely achievable if we stay invested. The past can also provide some great insight, although past market performance cannot predict the future. It's worth noting that the S&P 500 has produced positive returns for 34 out of the last 45 years, which is pretty good. So instead of viewing market corrections as a bad thing, just be prepared for them. Remember the next time, or remember the time to fix your roof isn't during a storm, right? The time to prepare is in advance. This means checking in with your financial advisor, making sure your investment plan reflects your risk tolerance and goals. And the biggest thing is if you've experienced any major life changes, right? Any job change or business is not doing well, maybe you're approaching retirement, a newborn, marriage, divorce, anything in your life that is drastically changing your financial situation, you need to connect with your advisor. We need to know so we can make the proper adjustments in your investment plan. And knowing that you're prepared for the next market slide will hopefully give you the confidence you need to stick with your plan. Next slide. A big part of navigating volatility, we always talk about this, is diversification. We hear this term a lot, but we rarely understand it, right? This involves investing across different types of investments or assets to spread out your investment risk. So you may know the saying, don't put all your eggs in one basket. And that's basically the idea here. While, again, it might seem basic, it is very powerful. By investing in small size companies, mid size, large, international, REITs, along with a mix of halal fixed income, you can create a allocation of different asset types that are best aligned with your, again, risk tolerance. And you might be able to offset some of the losses in one area while you're getting some significant gains in another area. So diversification can help limit your exposure to risk of any one investment. Think about it like this. If you were to simply invest in one company, you do risk losing all of your money because if that company goes under, there goes all your money. But diversification helps you spread it out, right? So diversification can help minimize risk, but it does not eliminate it. Just as diversification doesn't guarantee gains, it also doesn't completely shield you from losses. So there's no such thing as a perfectly safe investment. If anyone tells you, please be wary and run the other way. And of course, ensure that your diversified portfolio is still aligned with halal investment guidelines. Growing your money in a halal way is the foundation of your long-term success. And by working with a qualified Azad advisor, we can make sure that you are, we can help you walk you through that process, inshallah. And diversification means that you cannot invest only in the S&P 500, right? Sometimes people say, well, I own the S&P 500, I own the 500 biggest companies. But in reality, that is not proper diversification. If you look on your screen, right, we talk about this a lot, the lost decade, right? From December 2009, a 10-year period started where the S&P 500 index was actually a negative 9%. That's right, a negative return for an entire 10-year period. And the annualized return was a negative 0.95, I believe. So investors with a diversified portfolio over that same period of time that not just had the S&P 500, but they had mid-sized companies, small cap indexes, even like an equal weighted balanced portfolio, they performed much better. Mid-sized companies did 6.3%, small size 6.4. An equal weighted S&P 500 did 5.1% over that same period of time. So again, the lesson here is diversification across different asset classes. And we know that's proven to work itself over a long period of time. And this is where you might want to look at your portfolio, right? If you're heavily concentrated in a few large companies these days, think technology companies, the Mag 7, for example, you are probably not set up to navigate market turbulence and volatility. So this is where you do want to address this issue with your advisor and see how we can navigate ourselves out of those concentrated positions and diversify into other asset classes. Staying on the topic of diversification, this next slide demonstrates that no asset class stays on top or at the bottom for long. This is a look at all the Azad different various portfolios and their performance ranked each year going back to 2015 over the last 10 years. And as you can see, certain asset classes do well in certain years and not so well in others. And that's why at Azad, we provide our investors with a separately managed account. It replicates a diverse group of asset classes from REITs to international, small size, mid size, large cap stocks. And then we combine that with our halal fixed income to create, again, the right asset allocation strategy that aligns with your risk tolerance. True diversification involves investing in different types of assets. Again, this helps to spread the risk, reduce the overall volatility of your investment. And the key to diversification is to invest in assets that have low or negative correlation to each other. This means that one asset class is underperforming, another one is outperforming. And this helps to balance out your overall portfolio risk. And then you rebalance your portfolio. Rebalancing means bringing your investments back into alignment with your objectives and your comfort with risk. And talk more about rebalancing, I'll kick it back to you, Josh.
Thank you, Raj. And of course, your time horizon and risk tolerance will help determine the appropriate mix of investments in your portfolio. So, time horizon is simply the amount of time that you're planning on staying invested. Your time horizon typically depends on things like your age, investment strategies, and financial goals. People who won't need to tap into their investments for a while, for example, those who are quite a ways away from retirement, would generally have a longer time horizon than, say, people who are investing money for a home down payment that's 5 years down the road. If you already have a time horizon in mind, another question you should ask yourself is how much risk you're willing to take and how much you're able to take on in your investments. In other words, what's your risk tolerance? Risk tolerance is going to vary from person to person. So it's important to understand your personal level of comfort when it comes to investing your money. So at Azad, we can work with you to help determine a risk profile that fits you. It's determined based on your investor persona, shall we say. From there, we can create an all-weather type of strategy to help you navigate market volatility, like we've seen thus far in 2026, more comfortably. I should also mention very quickly that in times like these, the value of having a financial advisor, as Raj just alluded to, really shines through. But regardless of the market, several studies show that the money you spend on financial planning does pay off. So, in fact, these studies place the value of financial advice at anywhere from around 1.5 to 5% per year in excess returns. Last year, Russell Investments, a fairly reputable outfit, put the potential value of advisors at 4.87%, to be exact. The largest component of that total value comes from behavioral coaching. In other words, helping you, the client, to stick to a long-term investment strategy and not to sell in May and go away. It's not to chase performance and avoid making costly mistakes. Back to you, Raj, for some concluding remarks in this very enlightening presentation today.
Thank you, Josh. And one of the things I want to talk about in your entire investing lifetime, you're going to go through several periods of market volatility. A lot of these periods are going to cause you to second guess your investment strategy or even consider a different approach to managing your money overall. However, regardless of how the market is currently performing, it's important to stay focused on your overall approach based on your goals, time horizon, and risk tolerance. Downturns can be unsettling. It helps to view the market activity from a wider perspective. And we know since 1928, the US economy has gone through at least 25 bear markets. It also helps to remember that the bear market doesn't last forever. On average, it only lasts about 9.5 months. The economy regularly moves through business cycles of recovery and recession. And despite all the volatility in 2026, keep in mind we are still in a bull market. US stocks have broadly been in a bull market since late 2022, probably early 2023. It hasn't been perfect, it hasn't been smooth, it hasn't been evenly distributed. But the current market, going back to October 2022, it just in 2023, the S&P 500 large cap stocks delivered an approximate 26% return in 2023, followed by in 2024, an approximate 25% return. And then looking back just last year, it was somewhere between 16 to 18%. So that's three straight, very, very strong years, roughly 70% cumulative gains. And this is the classic bull market behavior. Again, by definition, a bull market is any sustained rise following a 20% drawdown. And this clearly qualifies, which is what we're experiencing. But again, it has not been perfect. It's not going to look perfect. And just keep a few nuances in mind, however. There is very narrow leadership when it comes to the rally. Much of this rally has been driven by mega cap, tech, AI stocks, not the entire market. Even in 2026, we've seen a lot of the gains are, again, heavily concentrated in a few sectors. Not all stocks or sectors have kept up. Small caps and equal weighted index have lagged at times. And periodic volatility, there have been pullbacks. We've seen some recent shocks. Again, it started, with tariffs, rate fears, geopolitics, like the Iran war. So again, these are all things that are constantly gonna be part of your entire investing life, and just got to stay focused. The market has still pushed to new highs in 2026 despite all this uncertainty. And again, the bottom line is we are in a bull market, and I believe with more room to run, but having a trusted advisor to help you along the way is very crucial. Next, again, looking ahead, right? The market's trajectory will likely depend on a lot of different factors, but the top three are going to be geopolitical development, right? Ongoing global tension, their impact on supply chain, investor sentiment, right? These are all things that we need to consider. AI, right? You hear that pretty much in every conversation. Two out of every three S&P 500 companies are talking about AI. They're talking about AI in their earning calls. They did last year, as of this presentation, Q1, same thing. AI is how is that implemented in their businesses? And again, this is not a trend. This is a signal. And the last time a technology that shifted this many boardroom conversations at once, probably the smartphone, and we know exactly how that turned out, right? And then economic indicators. These are inflation rates, interest rates, GDP growth. We're getting ready to get a new head of Federal Reserve, and he'll probably play a crucial role in shaping the market expectations. And while challenges persist, there's potential for markets to power even further beyond these recent all-time highs if corporate earnings remain robust and the economic conditions remain fairly positive. But as we discussed today, when you've got the right allocation, you got a plan, and you made it, in consultation, working with your trusted advisor, you can be in a better position to confidently navigate whatever the market throws at you in the future. And again, if you have any questions about how to do anything that we talked about today, reach out to your financial advisor. Let's schedule a meeting, go over your strategy, your financial plan, your risk tolerance, and we want to talk to you to give you more confidence for your financial future.
Thank you, Raj. Really appreciate it. And we just want to take this opportunity to inform you about our on-demand webinars, which are available at azadasset.com. Please do check those out. Some of the recent ones are on your screen now. Very popular one is the tax planning versus tax filing. We know tax season is over, but tax planning is a year-round process, and it's something we can help folks with should they so desire. I'll also plug our shareholder advocacy webinar. It's an important value add that we offer to clients, activating your assets to help agitate for corporate change. Really important topic and something very near and dear to my heart. Always popular is our Zakat webinar. So whether you're paying, Zakat in Ramadan or any other time, it's important to educate yourself, specifically on how to apply Zakat to newer newer concepts like in recent years, like Roth IRAs, 401ks, et cetera. So we talk about those in a great deal of depth and detail. You can find all that and more at azadasset.com. The link is on your screen there, or you can just navigate to the homepage and search. That is going to conclude today's presentation. I'd like to thank all of you who took the time to be here live with us today. If you'd like more information, please reach out to us. The email address is hello@azadasset.com. Be sure to follow us on social media as well. You can see the links there on your screen. And I will mention that the handle for our Facebook and YouTube accounts is @AzadFunds. You can find us on LinkedIn, popular way to reach out and connect and interact with us. That's under our full name, Azad Asset Management. Thank you so much for your time today. Thank you to Raj in particular for being with us and sharing your expertise.
Thank you, everybody. Salam.
Appreciate it. Wa alaikum salam.